Welcome to the Deep Dive Library, your go-to podcast for real talks on entrepreneurship, finance, and personal growth. No fluff, just bold insights to help you grow, build, and lead. Let's dive into the questions people always ask about starting up. Like, number one, how much money do I really need to start my business?
That's always the first one, yeah.
Then, should I use my savings, a loan, or raise money? How do I manage cash flow in those first tricky 6-12 months?
Critical period.
What are the most common money mistakes first-time entrepreneurs make? And finally, what tools or systems can actually help me keep my business finances, in order?
Good questions, all essential.
Today, we're tackling exactly these crucial questions. We're going to explore the financial realities, the nitty-gritty of launching and sustaining your venture. We've pulled insights from various business resources.
Right. The goal is to give you, the listener, a clear, actionable understanding. Cut through some of the noise around startup funding and financial management.
Exactly. Practical knowledge. So let's jump right into that first big one. How much cash do you actually need to get your business off the ground?
It's the foundation, isn't it?
Yeah.
And honestly, before you even think about making a sale, that prep work, understand your financial needs.
Yeah.
It's absolutely key.
So not just a guess?
Definitely not. The U.S. Small Business Administration, for instance, they really emphasize that calculating startup costs does more than just give you a number. It shapes, pretty much every decision.
Like how much funding to ask for.
Exactly. And how you pitch to investors, even just estimating, when you might actually start making a profit.
Okay, so it's about getting specific. The SBA talks about itemizing everything, right?
Spot on.
Right.
You've got those one-time expenses, things like permits, licenses, those often have pretty clear costs.
Yeah, you can look those up usually.
But then there are the estimates, things like salaries, maybe office build-out costs. That needs more digging.
So how do you estimate those accurately?
Well, the SBA suggests doing some real research. Talk to mentors, check industry benchmarks, get quotes from vendors. You have to put in the legwork.
Roll up your sleeves time.
Pretty much. And once you have that list, organizing it helps massively. Think one-time costs versus recurring monthly expenses. It paints the full picture, like a blueprint, really.
Okay, blueprint ready. You've got your number. Now, the next big hurdle, funding it. Personal savings. A loan. Raising money. What's the thinking there?
The funding pathways. Well, putting your own money in, that sends a strong signal.
How so?
It shows you really believe in it, right? Commitment. Forbes mentions this. Future investors often actually expect to see the founder has skin in the game. It tells them you're truly invested.
Makes sense. If you won't bet on yourself, why should they?
Exactly. But there's a caveat. Forbes also warns, don't cripple yourself financially, especially with personal debt.
Right. Don't mortgage the house necessarily.
Especially not if it puts you under huge pressure. An interesting point they make is about equity partners. Bringing someone in early can actually improve your financial ratios later.
How does that work? Like improve your loan to value?
Precisely. It reduces the proportion of debt compared to the value of your assets, makes you look less risky if you need a bank loan down the track. It's a balance.
A calculated risk with your own funds, then. What about loans? Are there specific programs, maybe?
There can be. SME South Africa, for example, points to some government-backed options there, like the Imbuwu Fund for Black entrepreneurs or the Arts and Culture Venture Capital Fund.
Okay, so specific funds for specific groups or industries.
Right. The amounts vary, and critically, you have to check the eligibility criteria deeply.
Yeah.
These aren't just free money. There are requirements. Ownership, sector, stage, lots of details.
Always read the fine print. Got it. And the other route, raising money from investors.
Yeah, bringing in external capital. One resource on financing sources makes a really good point about even money from friends and family.
Keep it professional.
Absolutely. Treat it formally, even if it's your cousin. It might involve equity, giving them ownership. So get it in writing. Protects everyone.
No handshake deals over dinner.
Please, no.
Yeah.
Then you have venture capital. VCs. They invest often larger amounts, but typically in exchange for a significant ownership stake.
And they're looking for certain things.
Usually, yeah. A proven management team, maybe some evidence the founders have already invested their own cash, some initial traction. They're often not the very first money in.
Right, so maybe self-funding or friends and family first, then VCs later if it fits. Okay, funding secured, hopefully. But now you got to keep the lights on day to day. Cash flow, that seems to trip up a lot of people.
Oh, it's huge. The Managing Cash Flow Participant Guide really hammers this home. Lack of cash is just a killer for new businesses.
Yeah.
It's the lifeblood, money in, money out. You have to watch it like a hawk.
The guide mentions the cash conversion cycle. Can you simplify that?
Sure. Basically, it's how long your money is tied up, from when you pay for, say, raw materials to when you actually get paid by your customer.
Ah, okay. So shorter is better.
Much better. A shorter cycle means you get your cash back faster, ready to use again. If it's stuck in inventory for months, that cash isn't available for rent or payroll.
Makes sense. So how do you actually improve that flow? What strategies work?
Well, the guide suggests a few practical things. Negotiating with suppliers is one. Maybe get invoicing terms instead of paying cash up front once you have a track record.
Buys you some breathing room.
Exactly. Same with your landlord. Can you negotiate lease terms or payment options? And the basics, of course. Boost sales, cut costs where you can.
Easier said than done sometimes, I bet. What about customers who pay late? That guide mentioned receivables too.
Yeah, slow-paying customers are a major drain. You've made the sale, the revenue looks okay on paper, but the cash isn't in the bank. It directly hurts your cash position. Research backs this up too.
So chasing invoices is part of the job.
Unfortunately, yes, or having a system for it. Now, there's also a really interesting approach from Mike McCullovitz's book, Profit First. It kind of flips the script.
Profit first. How does that work? Sounds bold.
It is a bit counterintuitive. The standard formula is sales minus expenses equals profit, right?
Yeah.
McCullough says. Sales minus profit equals expenses. You take your profit out first.
First. Before paying bills, how does that even work? Wouldn't you run out of money for expenses?
That's sort of the point. By taking a predetermined percentage for profit immediately, you force yourself to figure out how to run the business on what's left. It encourages frugality, innovation.
So it creates pressure to be more efficient.
Exactly. Make profit a deliberate habit, not just whatever's left over, if anything.
Okay, intriguing. How do you actually do that, practically speaking?
He suggests setting up multiple bank accounts, one for income, then separate ones for profit, owner's compensation, tax, and operating expenses.
Like virtual envelopes?
Kind of, yeah.
Yeah.
You allocate percentages of your income to each account regularly. Maybe move the profit money somewhere less easy to access, out of sight, out of mind.
And he recommends taking profit distributions.
Yes. Quarterly. As a reward, keeps the momentum going. It reinforces the whole system.
And what's this about real revenue?
Important point in his system. You calculate real revenue by taking your total sales and first subtracting the direct costs of delivering your product or service materials, subcontractors, things like that. Then you apply your profit percentages to that number. Gives a clearer picture of actual profitability.
Okay, a very different way to think about money management. Let's shift gears to the danger zones. Common money mistakes. What are the big ones that sink startups?
Yeah, there's a list of killers, unfortunately. Poor cash management, as we said, is probably number one according to some analyses like the Startup Accounting Mistakes That Kill article.
Just not knowing where the money is going or when it's running out.
Pretty much. And relying on just 1 month spending the burn rate can be misleading. You should really look at, say, a 3-month average and forecast forward.
Right, and not confusing your runway how long you can operate with just your bank balance.
Yes, they are not the same thing. Runway depends on your burn rate. A big balance can disappear fast if you're burning through cash.
What else trips people up?
Mixing personal and business finances. Classic mistake. Using the business credit card for personal stuff. It just muddies the waters completely.
Makes bookkeeping a nightmare, I imagine.
A nightmare. And it hides the true performance of the business. Plus, that article notes, business cards often don't help your personal credit score anyway. So keep them separate, strictly.
Simple, but crucial. What about reconciling accounts? Seems basic.
You'd be surprised how often it gets skipped. Not reconciling bank and credit card statements regularly means errors, or even fraud can go unnoticed for ages.
Okay. Anything else on the accounting side, like cash versus accrual?
Yeah, the choice of method matters. Starting with cash accounting is simpler, but switching to accrual later, which most growing businesses need to do, can be complex. Accrual gives a more accurate picture matching revenues when earned and expenses when incurred.
So maybe start accrual if you can.
It often provides better insights long term. Also, misclassifying expenses. Calling software a capital expense instead of an operating expense, for example. It skews your metrics.
Little details, big impact. Tax mistakes too.
Definitely. Trying to deduct deferred wages, money promised but not yet paid, is a no-no with the tax authorities usually. You typically deduct it when it's actually paid, and simply forgetting to claim eligible tax credits, leaving money on the table.
Ouch. Profit first also mentions some behavioral mistakes, right? Like overspending.
Yes, Mikulovich talks about how, even with decent revenue, just spending too much prevents building real financial health. Chasing growth at all costs without profit can leave you, well, broke despite looking busy.
And cutting your own salary to make numbers work.
He advises against that. A healthy business should be able to pay its owner properly. And another big one, basing decisions on your best ever month, not your typical month. That leads to cash crunches when reality bites back.
Planning for the average, not the exception. Okay, lots to avoid. So to wrap up, what tools or systems should people use to stay on track?
Well, foundational is good accounting software. Shopify South Africa highlights this. Tools like Xero, QuickBooks, or others help track everything: transactions, payroll, inventory, taxes. It organizes your financial world.
Makes it manageable.
Definitely. Some services even offer full bookkeeping and cash flow tracking, taking it off your plate.
Beyond software, any basic habits?
Absolutely.
Yeah.
Vicky Robin and Joe Dominguez, in Your Money or Your Life, stress the power of just tracking every single cent. Daily money logging. It creates awareness.
Sounds intense, but I can see the value.
It really connects you to your cash flow. And creating and reviewing a cash flow statement regularly is vital. Plus, reconciling bank accounts monthly. Basic, but non-negotiable for financial health.
So it's a mix of tech tools and disciplined habits. Consistent attention is key.
That's it, exactly.
We've covered a ton today: calculating costs, funding options, the absolute necessity of managing cash flow, pitfalls to avoid, and the systems to put in place.
It's a lot, but breaking it down helps. Remember, understanding costs is step one. Funding choices matter. Cash flow is survival. Avoiding mistakes saves pain. Systems provide control.
And that profit-first idea offers a really different lens, focusing on profitability from day one.
It's a powerful mindset shift for sure. But look, this deep dive, it's just the start for you. Keep learning, talk to mentors, get professional advice, and adapt everything to your specific business.
So the final question really is for you, the listener. What stands out as the most critical next step you need to take for your venture's financial health? And hey, if you found value here but haven't subscribed yet, why wait? Every subscriber fuels this channel to keep delivering the real game-changing content you need. Hit like, drop a comment, and subscribe. And no W, don't miss out on the next episode that could change everything for you.